speaking of earnings, just about 75% of the S&P 500 have now reported earnings. So take a look at some of the biggest winners and losers so far since reporting earnings. Ford is up 10%, JP Morgan up 9%, Caterpillar is down 5%, Alphabet and Intel are both down double digits. So do any of these earnings busts turn into bargain buys? Do you stick with the winners here? Tim, what do you say?
You know, I think a couple of them look very, very interesting. I think Google and Intel would be the places that I feel most comfortable based upon both valuation and companies that I don't think I get worried about execution. Intel talked about things that if you worry about the things they talked about, you worry about it for everybody. They talked about data center. They talked about China. But again, their data-centric business is something in terms of earnings quality people have wanted to see out of this company. I feel very good about the path they're on. The valuation is far from stretched relative to their peers in the chip space. Google, look, paid clicks were down significantly. And if you think about the first quarter and year over year, so the comps were really, really tough. And at least the analysis says that some of this is just related to YouTube new products that were initiated last year, which made a big run to YouTube, made it very difficult to hit those numbers again. If you looked at the gross margin, there was a lot to be really excited about. Mm-hmm. So they only grew at 19% for a company that usually gives you 21, 22. And they're also trading so far relative cheap to the rest of their peer group. I guess I mean FANG, and I guess I mean mega cap tech. This is the best bargain in the bunch, and I think Google, others, and other bets is starting to get some real traction, some stuff there.
You still like Google, but you're concerned about the conference call.
I actually, that was the worst conference call of the season, I think.
Wow.
Because I just felt like, okay, clearly people, me, everyone who owns the stock, were concerned. Why? What happened with this revenue miss? Let's be a little more specific so we can understand. Is this a one-time thing? Is this, what are we looking at here? And they really, I think, just did a very poor job addressing it. It was unclear to me whether they knew and didn't want to tell us or whether they weren't really sure what exactly was happening and how long it would take to resolve. Would it be resolved? None of those questions were answered adequately. And also, I think that cash hoard is just a ridiculous capital structure to have. One of the biggest cash hoards on the planet, and yet they buy a minuscule amount of stock back. I think they could really learn a lot from Apple doing some sort of, you don't need to become a dividend payer, but you should have a reasonable buyback when you're generating that much cash and you do so little with it.
Do you think all that unknown created the sell-off that we saw, though?
It ran up so much into it, though. It was having a huge month, and Facebook had put up good earnings, and Snap and Twitter, and so I assumed, actually, that they would as well. So it was really disappointing on a lot of fronts. However, I agree with Tim. At this valuation, with this great business, even if it was not as good.
They have too many levers to pull. So I would say Google and Intel. Intel is the same way that you grade people or grade companies on DRAM or NAND. Intel, for me, is data centers. So I think it's oversold based on data centers. It is oversold on an RSI. Google, too many levers to pull for you to say, I don't want to buy this on a dip. Kudos to Guy Adami, though. He flagged the 1150 level in Google, and it almost got there. I think it was 1158, but I think it's buyable right here. Those two are the standout names for me.
So it's funny, the question is, S&P is at all-time highs for all intents and purposes. NASDAQ also. And the question is, do you buy the winners or losers? And I think you really have to be careful of buying the losers here, okay? And I think that, we can differentiate. You guys are talking about two really high-quality companies. They both have very different prospects, and they had very different reasons why they sold off about 10% from those highs. But if you're saying to yourself, okay, what do I buy here at all-time highs? I think we're in the sort of market you want to be discerning. You don't want to buy losers. That being said, it comes back to time horizon. And I think if you have a long time horizon in both Intel and Google, you're just going to be fine.
And
Intel
what's long?
In particular,
More than 2 years.
You have to be looking out to the back half of this year into 2020. And Intel is really simple. The stock broke out in February. There was still a lot of enthusiasm. They had just had a beat. They just had a new CEO. They were doing some things on the strategic front. There's a lot of good announcements out of CES about some of the initiatives they have. So the stock went from 50 to 60. So now it's back at 50. That's a level, 2.5% dividend yield, trading below a market multiple, trading below all of its peers, the balance sheet, all that sort. That's when you start thinking about how do I get the stock back up to 60, and your time horizon has to be at least 6 months for that to happen, because it's not going to happen in the next few weeks.
But don't you need a turn in semis overall to get a turn in Intel?
You may not.
No?
Listen, there's so much outperformance in some of these other areas that we know, and it's going to take a stock like NVIDIA a very long time to get back up to its highs. AMD seems to be a slightly special situation. I just think that Intel's the sort of name that has a lot of valuation support. They have a lot of flexibility with that balance sheet. We know they buy back billions of dollars of stock.
So the opposite of what you said is Cat Tractor. So you look at Caterpillar. For me, it was something I never really get excited about this. This is a trade war. This is a global growth story when you start talking about what levers can you pull. But when they increase their dividend by 20%, when they pound the table on guidance, when they promise stronger profit margins, it kind of gets my attention. Why are they being so verbose about profitability? So I think this one's worth a look. I would actually be worth a nibble on buying Caterpillar, which usually they don't get me to pull into a stock like Caterpillar.
I'm surprised that you would say that, given your belief that the China trade deal would be a sell the news event. Wouldn't that be the same for a Caterpillar?
100%. And I think when I look at the stock, it's had a little bit of a sell the news event already. It's a year to date, it's only up 6%. So I don't find it to be overwhelmingly boosted going in there. I think it's sort of flatlining at this point.
Well, it's funny because I probably fit the same inconsistency on the opposite side. I'm generally, of the view that the China deal still could be something positive. I think global cyclicality may return somewhat. I get a little worried about Caterpillar because I just think that the structure of their core business is a little bit different than it was 10 years ago during the super cycle. So I think the old relative valuation metrics don't mean all that. 14 times 2020 earnings puts us at $175 stock, and that looks pretty darn attractive. But I'm just not sure you should put it at that multiple. I think you look at some of these names on EV/EBITDA. I think they should probably be trading in kind of mid-single digits, and therefore, Caterpillar's not a name I need to go out there and buy in this environment.
When you say structure of the core business, what do you mean?
Well, I think, first of all, what we've seen in the mining industry, what we've seen in some of the ag businesses, you're just not seeing the same kind of capex. You're just not seeing the same kind of global growth. And maybe you get the global growth, but it's not growth at all costs. I think the miners are actually being a lot more discerning about how they attack new capex.
We're jumping all over the place, and I'm going to talk about your a derivative of your Google for a second. Snap was a big loser in this cycle too. I think it was down about 10% in a couple days after its report. Now, granted, the stock is still up 100% of the year, but when you think about what you were just talking about Google and some of the reasons why they might have had that revenue miss, and some of the just kind of the chinks in the armor as far as some of those metrics. And then you think about what Facebook just said at this F8 concert, this developers conference. I say to myself, this is a very unique property that, they're not growing revenues like to the scale like Amazon right now is catching a lot of. This is Snap. This is Snap. Okay. So Facebook is
a bullish Snap call.
Yeah, Facebook is validating their business model. Google is starting to see Amazon and some others kind of take some share from them as far as. So I say to myself, this is a pretty unique property, and it's up 100%, but it looks kind of interesting at $11.
Can we segue into JP Morgan at this point? Because that's probably where Karen would like to jump in.
This is where
this
is kind of
throwing darts here.
So JP Morgan, first of all, financials as a whole, I think this is the best that financials are going to get. When you look back, let's talk XLF. Let's bring it from 50,000 feet up down.
What do you mean the best? Like the highs are in?
The highs are in. Now, granted, JP Morgan had a great quarter, record quarter. But when I look at the XLF is back to, I know we always talk about this, that it's not apples to apples, but when you look at the XLF, back to 07, pre-crisis, that's where we topped out, almost down to the penny on the XLF. I feel like something's getting priced in here. I feel like this is as good as the story is going to get. Lower taxes, deregulation. I don't think you should be diving into financials at this point.
The thing is, the story's not that good in terms of a market perspective. Yeah, by the way, they've outperformed the S&P over the last 3 or 4 weeks. Since rates bottomed, financials have outperformed the S&P by about 5%. But it's not like this has been such a fantastic run for financials that we should say, exhale, let me get out of this trade. You have to get back to money center banks that are trading at trough multiples. They're trading at 9.5 times. Historically, they're 10.5 times. They're basically trading at a recession multiple. And I realize people are bummed about the Fed, think they should be cut rates. We're going into a recession. That's the only reason why you should be jumping out of financials, because otherwise the valuations, the capital return approach, the balance sheets, and again, what they're not getting in net interest margins, they're being compensated by a credit cycle, which has got another gear to it, and that's very good for them.
Karen.
I love JP Morgan.
I was waiting for that.
It wasn't shocking to me that they reported good numbers, just for what Tim's saying. We know there's net interest margin pressure. That has been around for a couple of years now. They've been able to navigate it, as have some of the others. It is the most expensive of the money center banks that between Citi and JP Morgan and Bank of America, but it is the premier name. It's really just gotten back to where it was. It was a great month. Right. That was great. That day that rates, I don't know, March 27th or 8th, that was was absolutely the day to buy it. I think we may have had a discussion that day, Dan, about it. Do you recall?
Listen, you're always right, Karen.
Sounds like you did.
Okay. No, so I still own it here. I own Citibank here. I actually think there's maybe a little more upside in Citibank for the reasons you've said. It is the cheapest of the group by a lot.
It's also up the most, though. It's up 35% compared to, it's almost double what JP Morgan is.
But it was down the most last year. I mean, I've had them for a long time, but I also
you know what is interesting to me, though, is that you see the regionals, KRE, the regional banking index, that usually outperforms the XLF, and everyone always says that's because there's an M&A factor in that there's always maybe a 300 basis point premium to it. They're both dead even right now. So I don't know whether the KRE should be moving higher or the XLF should be moving lower. I would say it's the latter, not the former. So I would say that the KRE is probably where it should be and the XLF should be sold.